So we're now looking at Inv4801, and Inv4801 looks at portfolio management. So it looks at portfolio management, and when you look at portfolio management, so you look at managing investment portfolios, and when you look at managing investment portfolios, the whole idea is that you are now comprehensively looking at managing a client's investment portfolio. But if you look at the way this textbook is structured, it's mainly geared towards CFA, CFA level 3 as well, because it's one of the modules that you'll be doing at CFA level 3. But you'll see that what we cover for Inv4801 is not as comprehensive as how they cover it in CFA level 3 as well, because you see that the textbook is quite a lot of information. So what we do is that we cover the textbook focusing more towards preparing you for the exam for Inv4801 as well. So that is our main focus. So that's when we're going through the textbook, we're going to be focusing more on gearing you towards being able to answer the questions in the exam as well. So if you look at Inv4801, there are 7 study units that you're going to be covering, but these 7 study units, they are basically broken down but covering the chapters which are in the textbook. So you see that in the textbook, the chapters that you're going to be covering is the chapter 1, which looks at the portfolio management process and the investment. Then chapter 2, which looks at managing investors' portfolio. So chapter 1 looks at comprehensively is more like an overview of exactly how you are supposed to be managing an investor's portfolio, and also looks at the steps that you're going to be following when you're managing the investor's portfolio. Like, for example, you now need to find out, so from an American perspective, it's more geared towards like an American perspective type of investment management, where you are the investment advisor. You advise the client on the type of investment that suits them. And how you do that is that it means that you need to be able to interact and get as much information from the client as possible. Then from there, you prepare the investment policy statement for the client, so that you're able to now know exactly what are the needs of the clients, and what are the objectives of the clients, and what are the constraints that the client is going to be facing over the investment period. Then after that, you are now going to be able to now manage the portfolio and review the portfolio as well. And you're also going to be looking at to see that, okay, fine, over the investment period, how are you going to be now assessing to see if the portfolio manager, that the investment that you've recommended, how are they performing as well, to see if it's still a good investment for the client, or you would rather what? Change the investment for the client as well. So those are overall the things that you're going to be looking at. So it's more like a more comprehensive offering for a client, where you meet the client, you gather the information, you recommend investments, you review the investments over time as well, to see if they're able to meet the different goals that the client has already set aside or has indicated there in your meeting with the client as well. So you see that the first 3 chapters, they are mainly geared towards that process of creating the investment policy statement for the client. So that's basically what you're going to be looking at in the first 3 chapters. And when you're preparing the investment policy statement, there are certain things that you're going to be looking at, the objectives and the constraints. We'll look at them as we cover chapter 1. Then you will see that chapter 1 looks at the portfolio management process and the investment. Then now, after looking at it already, to see exactly how you prepare the investment policy statement and all those other things that are going to be when you gather the information, so that you're now able to actually make the final recommendations to the client as well. Chapter 2 now looks at individual investor portfolios, to see exactly how would you structure a portfolio for an individual. Then chapter 3 looks at managing institutional investor portfolios, to see exactly how would you manage a portfolio if it's an institutional investor. Remember, we looked at individuals. Now you're looking at managing an institutional portfolio for an investor as well, who's what, an institution. So you see that chapter 2 and 3 are very much linked to chapter 1, so which means that chapter 1 forms the foundation of what you're going to be looking at when you're preparing the investment policy statement for an individual or for an institution as well. Then chapter 4, but you see that the principles of the constraints and the objectives there, you are still going to be basing on the principles of the constraints and objectives that you're going to be looking at there, although they are going to be what affecting the investor, individual investor, or the institutional investor differently as well. Then chapter 4 looks at capital market expectations. So this is basically more or less on finding out exactly how do you now determine the expected return of the portfolio. Because remember, at the end of the day, you are now going to be, when you're making when you're now assessing your investment to see if it's a good investment or not, you need to find out exactly, so how much would be the expected return of this investment, so that over time, when you now get the actual return, you are going to be comparing the actual return against the expected return of the investment portfolio as well. Then chapter 5 looks at asset allocation to say the different investment assets that you are going to be investing in. How do you now allocate to say this is what percentage are going to be putting in one asset, the percentage that are going to be putting what in the different asset, and how do you now what are the categories that you can also use to classify different assets? Are you going to classify them as for example, money market investment, bonds, or property investments, or equity investments? Then you also make those decisions as well. And there are different classifications that we're going to be looking at when you look at what asset allocation. Then chapter 6 looks at fixed income portfolio management. Now, when you're looking at the different assets that you're going to be considering investing in, remember, you can either consider investing in what, in shares, which is equity of different of different companies, or you can consider investing in what, in debt, which is basically, like, for example, fixed income, and in this case it would be what, in the case of what, of bonds. So when you look at fixed income portfolio management, you're looking at investments in what, in bonds, to see exactly, so how do you go about coming up with a portfolio for what, for fixed income portfolio management, which is mostly going to be based on the what concept of investing in bonds as well. Then chapter 7 looks at equity portfolio management, where we say that it's either you can invest in equity or you can invest what, in debt, which is basically bond type of investments as well. Then chapter 8 looks at other alternative type of investments which are not categorized as either equity and liabilities. Like, for example, when you look at real estate, commodities, hedge funds, and how they're structured as well. So this is basically how you can also look at other alternative investments apart from the traditional type of investment that everybody have been used historically. Then chapter 9 we don't do, chapter 10 we don't do, 11 we don't do. Then chapter 12 looks at evaluating portfolio performance. So chapter 11, now that you've made the investment decisions and you said, okay, this is where we want the clients to invest in, over time, you are now going to be periodically evaluating the performance of your portfolio. So you now are going to be agreeing with the client on exactly how often are you going to be evaluating the performance of of the investment, depending on exactly what your investment style is. Are you looking to do investment where you just do passive investment, or are you going to do investments where you're looking at actively managing the portfolio? So this is where you can now over time look at evaluating the portfolio performance to see is it still in a position to meet the goals that you've set aside or that you've set up for the portfolio, to say, because remember, when you meet the client initially, they're going to be saying, I want to invest this money so that maybe after 5 years or after 10 years, this is the objective of for how much I want to be able to have grown so that I'm able to achieve this particular objective. So which means that over time, you're now going to be reviewing to see how far are we from being able to achieve this particular objectives that we have, that is the client is set up for us as the investment house as well. So do you see how these different chapters look and link when it comes to investment management for portfolio investments as well? So that's basically overally what you're going to be looking at. And at the end of this module, you should be able to have an idea or a good understanding of exactly how you can actually set up a portfolio for a client and how you can actually make recommendations and how we can also review the performance of the different portfolios that we have invested or recommended for the clients as well. So that's what you're going to be covering, and our aim is that we should be able to cover these chapters by end of October this year. So which means that over the course of the year, we'll be covering these chapters, and over the course of the year, I'll also be giving you homework questions, because I like, especially for Inv4801, I prefer going back to the homework questions, mainly because some of the questions that the lecturer would have brought maybe 3 years ago or a couple of years ago, sometimes he bring back those questions, although he just twist the question a little bit, but sometimes he bring back some of the questions as well. So we need to make sure that we keep practicing as much as possible, so that if they change it, you still won't get lost on exactly what you're trying to achieve when it comes to answering the question. Then usually this module has 2 assignments. So as we go sometime in April, well, I'm going to be announcing exactly when we're going to be doing the assignments together in class, so that we make sure that we cover and maximize as much marks as possible before we go on to the exam as well. Then our plan is that from November, December, January, until you guys write in February, we'll be doing and concentrating on revision, where we're going to be looking at past papers, past assignments, and also any other revision question that the lecturer would have posted as well. So are there any questions before we go on to chapter 1? Also, please take note that all our sessions are recorded, which means that if you miss the class or there's something that you didn't understand in the class there, you will be able to access the videos of the sessions that we are going to be having. So you can use these videos now to actually go back and review, or maybe say, let's say for example, sometime in December or January, you are revising and there's a chapter which is still giving you problems, you can still go back to those videos so that you go and polish up on the concepts that you're still struggling with as well. So I would really recommend you to actually go back to the videos as much as possible and utilize them. And what we would also do is that before every class that we have, we will make sure that the video of the next class, we make it available to you guys, so that you have it on hand, so that at least you can go through the video of the next class in advance, so that when we go through that chapter again together in class, you would have gone through the material and you'll be revising. It makes it easier for you to actually understand those concepts as well. And there are some chapters that are going to be making sure that we bring in as much homework questions as possible, especially when it comes to chapter 2, which looks at preparing the investment policy statement for individual investors. It's a highly examinable concept, and you find that the lecturer always plays around with the different concepts in that chapter as well. So we need to make sure that we practice it as much as possible. All right, so are there any questions before we go on to chapter 1? So chapter 1 looks at the portfolio management process and investment. So today, our aim is to cover chapter 1. Then after covering chapter 1, what I'm going to do is that I'm going to make the video for chapter 2 available on your student portal, so that as soon as we're done with this class, before you go on to the next class as well, you will be able to actually access the video, go through the chapter by yourself, so that when we go through the chapter again with you, you would have actually polished up on, and you'll be polishing up on the concepts that you're still finding difficult to go through as well. So chapter 1 looks at the portfolio management process and the investment policy statement. And under introduction, on page 2, they say the portfolio management process is an integrated set of steps undertaken in a consistent manner to create and maintain an appropriate portfolio to meet clients' stated goals. Then if you go to the next paragraph, line number 2, they say an investment policy statement is a written document that clearly sets out the client's return objectives and risk tolerances over the client's relevant time horizon, along with the applicable constraints such as liquidity needs, tax considerations, regulatory requirements, unique circumstances. So the portfolio management process moves from planning through execution and then to feedback. So in the planning step, investment objectives and policies are formulated, capital market expectations are formed, and strategic asset allocation are established. In the execution step, the portfolio manager constructs the portfolio. In the feedback step, the manager monitors and evaluates the portfolio compared with the plan. So any changes suggested by the feedback must be examined carefully to ensure that they represent long-run considerations. Then on the next paragraph, on line number 2, they say, the investment policy statement must clearly communicate the client's objectives and constraints. So which means that when you're looking at your portfolio, when you're looking at the portfolio management, the main aim of this chapter, which is chapter 1, is to find out exactly, so what are the steps that you need to follow when you look at portfolio management, and also how do you now create the investment policy statement, which is basically that documentation which basically gives you the guidelines of exactly what are the objectives and what are the constraints, so that if you document them, they are also used as a safeguard, so that, remember, when it comes to investments, no one can predict the future. So because no one can predict the future, that's why you see that investment houses are always asked to refrain from making promises to say, we are promising to give you a certain return, unless it's a guaranteed investment. If it's not a guaranteed investment, you should not promise a particular return, because remember, it's all based on how the market performs as well. So because of that, you will find that if you set these objectives, and you now make a recommendation to the client, say, okay, fine, invest in an aggressive investment. What happens later on when the investment loses value? When the client suffers losses there, you will see that if you are going to, as an investment house, you also be covered on your side, because if all the agreements that you have made would be documented. Because remember, on the investment policy statement, the client is also going to be once you prepare, you meet the client, you make your recommendations, you prepare the investment policy statement, the client is also expected to sign on that investment policy statement, and also initial on every page, to show that you've advised the clients and the client is aware of exactly what recommendations you made and what are the risks involved in the recommendations that you've made. So it's basically a documentation that is that is also made available to ensure that all the things that have been agreed upon in the initial meeting and the objectives and the constraints are clearly stated, so that anything in the future goes wrong, everyone can go back to, they say, this is what we agreed on, and this is what we said were the objectives, and this we say how we said we're going to meet those particular objectives as well. Then on the next paragraph, they say, when combined with capital market expectations, the investment policy statement forms the basis for the strategic asset allocation. So capital market expectations concern the risk and return characteristics of the capital market instruments, such as stocks and bonds. So the strategic asset allocation establishes acceptable exposures to investment policy statement permissible asset classes to achieve the client's long-run objectives and constraints. So when it comes to the strategic asset allocation, let's say, for example, you agree with the client that, you know what, for our investment, let's say, when you look at asset classifications, you can classify assets as money market investments. You can classify assets as bonds, and you can also invest in real estate, and you can also invest in equity as well, right? So you see that when the more you're going in this direction, when it comes to this asset classification, with the more you're going in this particular direction, the risk is increasing, and at the same time, the expected return by the investor is also increasing. Because remember, high risk, high expected return. Remember, it's an expected return, not an actual return. But at the same time, the time horizon is over which the investment is to be done is also expected to be what? To be increasing as well. So what do we see? So when it comes to the strategic asset allocation, this is where I'm going to be saying if our portfolio can either invest in money market, bonds, real estate, and equity, how much of our portfolio are we going to be putting in these asset classification, depending on exactly what the risk appetite of or how much is the risk classification of what of the investor. Because remember, when you look at the risk classification of the investor, an investor would be considered as either conservative, or it can be having a moderate risk appetite or an aggressive risk appetite as well. So remember, risk is increasing as we're going that direction as well, right? So what do we see? It basically means that if the investor is having a more aggressive risk appetite, they're investing more here. If the investor is having a moderate, they're having like more of a mixture of these asset classes, depending on the weighting that they give as well. If the investor is having a conservative risk appetite, they're having more of a mixture of what in this direction as well. So what do we see? The strategic asset allocation is now the agreement to say, in the long run, how do we plan to have our portfolio be structured? Like, for example, they can say, we want 5% of our portfolio to be in money market. We want, let's say, 20% of our portfolio to be in real estate, and we want 25, in bonds, and we want 25% of our portfolio to be in real estate, and then we want 50% of our portfolio to be what? In equity. So which means that in this case, 50 plus 25 plus 20 plus 100%, which makes up what? 100% of your portfolio. So this is basically what they look at when they look at what asset, strategic asset allocation. We're saying that over the long term or over the investment horizon, our aim is to have the structure of our portfolio to be something like this, for example. So this is basically what they look at when you look at what strategic asset allocation, depending on exactly what the risk appetite is of the investor as well. So it can be different. You can even have more percentage here and less and less and less, depending on exactly what the overall risk appetite of the investor is. Because usually what happens is that most of these investment houses as well, if the client says that if they do ask the clients, usually they ask the client about 10 questions or so, and from those 10 questions, they're able to now ascertain in which risk category the client falls under, and depending on the risk category the client falls under, they can now have portfolios which basically meet that risk category as well. Because remember, most of these portfolios on the investment on the information about the portfolio where it's invested, it will be indicating exactly what the risk of that particular fund would be as well. So depending on the risk of the fund, that's when they're argued. But remember, at the end of the day, the strategic asset allocation is to say, in the long run, what percentage are we putting in the different asset classes as well, depending on the risk appetite of the investor. Are there any questions on section 1 before we go on to section 2? So section 2 looks at investment management, and here they say investment management is the service of professionally investing money. So which means that you're having a professional investor who's going to be offering that service at a fee to actually invest the money of the general public as well. Then if you check at the bottom of page 3, on the last paragraph, they say investment management companies employ portfolio managers, analysts, traders, as well as marketing and support personnel. So portfolio managers may use both outside research produced by sell-side analysts, so which means that when they're getting information or when they're buying information from outside researchers, they are referred to as sell-side analysts. and research generated by in-house analysts, which are also called buy-side analysts as well. So these are the in-house analysts who are also going to be analyzing the markets and making recommendations to say these are the good investments and these are the investments that you need to be able to ideally sell if they are part of your portfolio as well. Section 3 looks at the portfolio perspective. And when it comes to the portfolio perspective there, this is basically where you're now going to be looking to say the portfolio perspective is the books for is this books focus on the aggregate of all the investors holding the portfolio. So because economic fundamentals influence the average returns of many assets, the risk associated with one asset's returns is generally related to the risk associated with other assets returns as well. If we evaluate the perspective of each asset in isolation and ignore their interrelationships, we will likely misunderstand the risk and return prospects of the investor's total investment position, which is our most basic concern. So here, they're basically saying that when you look at it from the portfolio's perspective, it basically means that when you're assessing the performance of your portfolio, you have to look at it to see exactly what is the overall performance that you're expecting from your portfolio, and what are the relations between the performance of the different assets which makes up your portfolio as well, which means that overall you will now have to look at to see exactly what are the correlations between the assets that are going to be making up your portfolio, to see how they end up affecting the overall performance of your portfolio as well. So one model that is used in assessing the portfolio, this is where they talk about the model portfolio theory, which is basically used to assess the performance of and used to structure the expected performance of the different portfolios as well. So just take note of it, but I don't see anything that I would say is highly examinable. That's why I didn't highlight it there as well. Section 4 looks at portfolio management as a process. So we now look at portfolio management as a process, and on the next section, we're also going to look to see exactly what are the processes involved as well. So on section 4, on page 5, line number 3 from bottom of line number 4 from bottom of the first paragraph, they say portfolio management is a continuous and systematic process complete with feedback loops for monitoring and rebalancing. So the process can be as loose as or as disciplined, as quantitative or as qualitative, and as simple or as complex as each operator's desire as well. So which means that it carries so many different characteristics depending on exactly how you are going to be how you are planning to be managing your portfolio. So if it's loose, it's basically where there are no strict rules on exactly how you do the monitoring and rebalancing of your portfolio. And if it's based on quantitative or qualitative analysis, this is where, if it's quantitative, this is where you're now going to be looking to see exactly based on the numbers of how much the performance has been. So which means that your decision on whether to cut or remove a particular asset in your portfolio is going to be based on the quantitative performance of that asset, which is basically based on the numbers, to say if it's 10% benchmark, it basically means that they're now going to be checking to see has it performed above 10% or performed less than 10%. Or it can be from a qualitative basis there, where you're now going to be saying, is it average? Is it before the, generally, are you saying that this performance is average, below average, or above average as well? And this can also be simple or complex, depending on exactly how your investment plan is going to be. Are you going to be looking to see just where you are going to be having a few assets, because it's a simple monitoring and rebalancing if you're just going to be having a few assets which makes up your portfolio, or it can be very complex depending on exactly how many assets that are going to be making up your portfolio of investment portfolio, or the assets of how much the assets of your investment portfolio are going to be making up your portfolio as well. Section 5 looks at the portfolio management process logic. And here they say 3 elements in managing any business process are planning, execution, and feedback. So which means, so these are the steps which are followed when it comes to the portfolio management process as well. So on the first step, which is the planning step, this is where they say you need to identify, this is where you are looking at identifying and specifying the investor's objectives and constraints. So the first task is, task in investment planning is to identify and specify the investor's objective and constraints. The investment objectives are desired investment outcomes. So in investment objectives chiefly pertain to return and risk. So the constraints are limitations in the investor's ability to take full or partial advantage of the particular investments. For example, an investor may face constraints related to the concentration of holding as a result of government regulation or restrictions on the governing legal document. Constraints are either internal, such as clients' specific liquidity needs, time horizon, unique circumstances, or they are external, such as taxes and legal and regulatory issues as well. So which means when you now, these issues are what you're going to be addressing when you are going to be preparing the investment policy statement. So when you prepare the investment policy statement, these are the issues that you're going to be addressing. Whether the investment policy statement is for individuals or it's for institutional investors, the issues are basically the same. So remember we said that when it comes to the preparation of the investment policy statement, you are going to be having issues where you have objectives, and the objectives would be risk and return. So these are the two objectives that you're going to be addressing when it comes to preparation of the investment policy statement. Then there is also issues of constraints. So there are also constraints that are going to come about when it comes to preparation of the investment policy statement. And these constraints, they can be liquidity needs, time horizon, and unique circumstances. Then there can also be legal and regulatory issues. So there can be tax issues, and there can be legal and regulatory issues as well. So these are the issues that are going to be coming about when it comes to the preparation of the investment policy statement. And remember, we said these are internal constraints, and these are external constraints. So you need to be able to do this classification when you are going to be now addressing the preparation of the investment policy statement as well. Usually, to make it easier for me to remember, I use the acronym RRLLTTU. So usually, for me to be able to know exactly what are the objectives and constraints that are going to be addressed when it comes to the investment policy statement preparation, I use this acronym RRLLTTU, where this is your risk, return, legal, and liquidity, tax concerns, time horizon, and unique circumstances as well. So these are the issues that you need to be able to address when it comes to investment policy statement. So make sure that you're able to now classify them either into objectives or constraints, and also being able, even amongst the constraints as well, you need to be able to classify, understand and classify to see which ones are the internal constraints and which ones are the external constraints as well. Any question so far before we go on? And remember, we're going to be looking at these individually as well later on. So later on in this chapter, we're not going to be looking at them in detail to see what are the risks, what are the return, what are the legal, what are the time horizon, what are the liquidity needs, what are the time horizon, what are the unique circumstances, what are the tax issues, what are the legal and regulatory issues as well. So we are going to be looking at them, each one of them in detail as well. So please make sure that you take note of this. So On section 5.1.2, they say, on the last sentence of that first paragraph, they say, a typical investment policy statement includes the following elements: a brief description, a brief client description, the purpose of establishing policies and guidelines. Then it also includes the duties and investment responsibilities of parties involved, particularly those relating to the fiduciary duties, communication, operational efficiency, and accountability as well. So parties involved include the client, any investment committee, and the investment manager, and the bank custodian as well. Then they also say the statement of the investment goals, objectives, and constraints, the schedule for review of investment performance, as well as the investment policy statement itself, the performance measures and benchmark to be used in the performance evaluation, any consideration to be taken into account in developing the strategic asset allocation, the investment strategies and investment style, and guidelines for rebalancing the portfolio based on feedback. So these are the issues that are going to be addressed when it comes to the preparation of the investment policy statement. So these issues are basically what are going to be basically what is being summarized in this particular diagram as well. So how they go about preparing this is basically what they are summarizing in this particular diagram as well. So when it comes to, after this, they say the investment policy statement forms the basis for the strategic asset allocation, which reflects the interaction of objectives and constraints with the investor's long-run capital market expectations. Then on the last sentence of that paragraph, they say, in the broadest sense, investment strategies are passive, active, or semi-active. So which means that the investment strategies that are going to be pursued by the portfolio manager can be classified as either passive, active, or semi-active. So semi-active is more like a hybrid between passive and active investment management there as well. So now looking at these investment strategies, the first one, which is the passive investment strategy, they say in a passive investment approach, portfolio composition does not react to changes in capital market expectations. So which means passive basically means what? Not reacting. So which means when it comes to passive investment strategy, the first type of passive investment strategy is basically what they refer to as indexing. So one type of investment, passive investment strategy is what they refer to as indexing. And with indexing, this is where the portfolio manager tries to create their own portfolio which mimics a particular index. Like for example, if you check on the JSE, we have what we call the all-share index, right? So the all-share index shows you the average, the weighted average performance of the securities which are constituted, which are listed on the JSE as well, right? Now, when you look at which is basically shares, right? So when you look at indexing, for example, if the portfolio manager tries to mimic or create an index portfolio, use indexing when it comes to creating or mimicking what? The all-share index, they are going to try to create a portfolio which is which is invested in this almost the same weights as the investments which are making up what are constituting the all-share index as well. So that on average, so which means that their expectation is that the performance of the portfolio is going to be closely mimicking the performance of the what? Of the all-share index, for example. So this is a typical example of what they refer to as what? As indexing. A second type of passive investing is a strict buy and hold strategy. So with a buy and hold strategy, this is where you buy if you are going to be saying, okay, fine, we want to invest over a period of 5 years, you are now going to say, okay, which investments are we going to be investing in? Then you choose and make decisions on exactly what investments you are going to be investing over that particular 5-year period. Then over the 5-year period there, you're not going to be chopping and changing. You're just going to hold on to that investment until the end of the investment horizon. So that's another type of what passive investment approach, which they refer to as passive, which is basically buy and hold strategy as well. So those are the two types of passive investment approach. Is there any question when it comes to the passive investment approach? The second type of investment strategy is active investment strategy, where they say on the second bullet, in contrast with an active investment approach, a portfolio manager will respond to changing capital market expectations. So active management is a portfolio means that its holding differ from the portfolio benchmark or comparison portfolio in an attempt to produce positive excess return, adjusted returns, also known as alpha. So when it comes to active investment approach, it basically means that the aim is to generate what they call alpha. So as a notation, alpha is like this, and this is what they refer to as the alpha return, and they also refer to it as this is your excess return. So you're trying to generate excess returns, so which means the aim for active portfolio management is to ensure that to generate this excess return, you are saying that the return of the portfolio should be more than the required return of the portfolio. So the return of the portfolio should be more than the required return. So if it's more than the required return, that's when we're saying that generating what? A positive or positive alpha, because your return of the portfolio is what? If it's positive, it means that the difference there is going to be positive. But remember, your alpha can also be negative if you are failing to what? To meet the required return. And remember, this required return can be based on any benchmark that you would have set yourself for as well. Like, for example, if you say your benchmark is to beat a certain absolute return, it basically means that your alpha is going to be saying how much is the actual return of the portfolio and how much did you set as the benchmark return. So if it's positive there, then you have a positive excess return. And if it's negative, you have a negative alpha as well. Are we on the same page before we go on? So the main aim of active investment management is to generate returns. So the main aim is to have the return of the portfolio being greater than what? The required return that will be what? That has been set forth at the beginning of the investment horizon as well. So the main aim is to generate returns which are more than the benchmark return or the required return. Any questions before we go on? Next, on the third bullet, they say a third category, the semi-active risk-controlled active or enhanced index approach seeks positive alpha while keeping tight control over risk related to the portfolio's what? Benchmark. So with a semi-active investment strategy, the ultimate aim there is to say, yes, we want to produce excess returns, but we need to make sure that we keep a tight control over the what? Over the risks that we're taking, right? So our main aim is to produce a positive alpha, but at the same time being able to keep a tight control over the risk that we're going to be taking there as well. So what it basically means that with a semi-active return, this is where the portfolio manager now can say, okay, fine, of the total portfolio that we're going to be having, a certain percentage is going to be actively managed, and a certain percentage is going to be what? Passively managed. So you're having a combination of what? Actively managing the portfolio and passively managing the portfolio. How much is actively managed and how much is passively managed will now depend on exactly what the risk appetite of the that is set forth for the what? For the fund would be as well. So you're having a combination of actively managing the portfolio and some of it being what? Passively managed as well. So that's when you're going to be having um, semi-active investment strategy. So on the next paragraph, they say active investment approaches encompass a very wide range of disciplines. To organize this diversity, investment analysts appeal to the concept of investment style. So following Brown and Guzman, we can define an investment style such as an emphasis on growth stocks or value stock as a natural grouping of investment disciplines that have some predictive power in explaining the future dispersion in return across portfolio. So we'll take up the discussion of investment strategy and styles in a greater detail in subsequent chapters. So we're going to be looking at this in subsequent chapters as well. And when they talk about value investing and growth investing, this is basically two investment styles that can also be used to categorize what active investment management style, where with growth investing, this is where the main characteristic of growth investing, these are, for example, if it's stocks, these are stocks where the investment does not pay out dividends. So which means that the main aim is to make sure that you reinvest as much as of your returns as possible, so that the company is able, this company is able to actually to grow as well. So with growth investing, you are looking at investment stocks where your investment style is based on investing in those stocks where the companies are usually reinvesting a lot of their stocks as well, so that there's a little growth. And usually when it comes to growth investment, we're going to look at it later on in the chapters as well. This is where you usually see it a lot in IT, where most of the IT companies, they usually spend a lot of their money in research and development, so that they're able to actually come up with new ideas, innovative ideas to stay relevant and grow the company as well. That's why you see that, for example, companies like Microsoft, for a couple of years when they started off, they were not paying dividends. Then later on, as the company reached maturity stage, that's when they started paying dividends as well. So they're basically following the growth investment type of strategy as well. Then there's also the value investment type of strategy, where with the value investment type of strategy, this is where the portfolio manager is looking for those stocks of investments which are considered to be undervalued. So the idea is to buy undervalued stocks with the expectation that over time the share price is going to go up, then sell the stock when it is has reached a certain value before it becomes it's considered overvalued as well. So that's basically what they look at when you look at the different investment styles. So please make sure that you take note of these as well. On page 8, which is section 5.1.3, we look at forming capital market expectations. So when you look at forming capital market expectations, it's part of the planning stage as well, or planning step, where they say the manager's third task in the planning process is to form capital market expectations. Long-run forecasts of risk and return characteristics for various asset classes form the basis for choosing portfolios that maximize expected return for a given level of risk and minimize risk for a given level of expected return. So which means when it comes to forming capital market expectations, you want to ensure that you understand the relationship between risk and return. So ideally, this is where we're saying that when you look at the relationship between risk and return, you are looking to invest in those portfolios which are basically found on the efficient frontier, because those portfolios which are found on the efficient frontier are those portfolios which are able to maximize return for a given level of risk or minimize risk for a given level of return. So when you look at your efficient frontier, this is where, if you still remember from undergrad, you are having a graph which is something like this, which shows you the relationship between return and risk as measured by standard deviation, where you, if asked to choose between two portfolios, one, so you have portfolio A and portfolio B, and then you have portfolio C as well, right? So you have portfolio A and portfolio B and portfolio C as well, right? So if you look at these portfolios, if you are asked to choose between portfolio A and portfolio B, so if you're asked to choose between portfolio A and portfolio B, which one would you choose? Would you choose portfolio A or would you choose portfolio B? So if you're asked to choose between portfolio A and B, which of the two portfolios would you choose, A or B? A, right? Someone posted A. Remember, you can unmute yourself if you want to participate. Then mute your after you participate, then you can mute yourself again as well. So you're able to do that. So I see someone. Yes.
Oh yes, I was saying A. I'll choose A because A is the same return, but it's lower risk. So
yes, yeah. Yes. So which means you would choose A if you have asked to compare between portfolio A and B. You would choose A because for the same return, A exposed is exposed to less risk, isn't it? So this is why we're saying that when it comes to forming capital market expectations, the idea when you look at the relationship between risk and return, you want to ensure that you minimize your risk for a given level of of return. So you want to be able to minimize your risk for a given level of return. Hence, you would choose to invest in portfolio A as well. Then, if you're asked to compare portfolio C and B, if you're asked to choose between portfolio C and B, which one would you choose then?
I think you choose C because it's higher return, but it's the same amount of risk.
Yes. So for the same amount of risk, C is giving you a higher return, isn't it? So which means that this is basically what you're now going to be doing now when you're looking at forming capital market expectations, because at the end of the day, the portfolios that you're going to be choosing there, you also want to make sure that for a given level of risk, you're able to maximize the returns. Because if you're able to do that, it basically means that your portfolio is able to actually perform at its best level as well. So this is basically what you're going to be looking at and trying to achieve when you look at forming capital market expectations. Are we on the same page? So over time, you also see that your choice between C and A will usually depends on your risk appetite. If you have a high risk appetite, you invest in C. If you have a low risk appetite, you would choose to invest in in A. So it will depend on exactly what the risk appetite of this particular investor that you're assessing on, how much their risk appetite is going to be. If they are more aggressive, you put them in C. If they are more conservative, you put them in in A as well. Any questions? Can we move on? All right. So on section 5.1.4, we look at creating the strategic asset allocation. And here they say the fourth and final task in the planning process is determining the strategic asset allocation. And here, the manager combines the investment policy statement and the capital market expectations to determine target asset class weights. Maximum and minimum permissible asset class weights are often also specified as a risk control mechanism, which means when it comes to strategic asset allocation as well, it also means that you're going to be saying roughly how much are we going to be putting in the different asset classes as well. And another way of managing you're managing your risk when you look at strategic asset allocation is by putting what ranges of permissible allocations as well, so that you are avoiding having a situation where in the short run, which we call tactical asset allocation, in the short run, you don't want a situation where the portfolio manager ends up investing 100% of the portfolio in in equity, because they're trying to seek a better return, which ends up overexposing the investor as well. So you can also put in, as part of the strategic asset allocation, you can also put in to say these are the permissible range of percentage of investments of the portfolio that that the investor or that the portfolio manager can allocate or put in as well. Any questions on the first step before we go on to the second step? So on the second step, this is the execution step. And here they say the execution step is represented by the portfolio construction and revision box in Exhibit 1.1. So remember, the exhibit that we looked at previously, it's basically showing us the steps that are followed from the planning step to the execution step to the review and rebalancing as well. So it's basically showing you the steps that are followed there, right? So here they say, in the execution step, the manager integrates investment strategies with the capital market expectations to select the specific asset for the portfolio. The portfolio section or composition decision. So portfolio managers initiate portfolio decisions based on analyst inputs, and trading desks then implement these decisions as well, which is basically the portfolio implementation decision. So here they say subsequently, the portfolio is revised as investors' circumstances or capital market expectations change. Thus, the execution step interacts constantly with the feedback step as well. So looking at this, when you look at now portfolio optimization, this is where you're saying that overall, when you're trying to optimize your portfolio, when you look at the feedback and the review and the feedback loop as well, this is where you're trying as much as possible to maximize your return for a given level of risk and minimize your risk for a given level of return as well. Now, when it comes to a rebalancing of your portfolio over time as well, this you can also follow what they call the tactical asset allocation. So with the tactical asset allocation, on the second last paragraph of that page, on the last sentence, they say, tactical asset allocation responds to the changes in short-term capital market expectations rather than to investors' circumstances. So it responds to the changes in capital market expectations. Like, for example, you are having a portfolio where you are aggressively investing, where the portfolio is mostly invested in equities there as well, right? So what do you see? Now the portfolio manager can see that, we are approaching a recession, or we are having a situation where we are now we are likely to be approaching a pandemic, and it's going to be negatively affecting the shares or the securities or the equity portfolios that we're holding as well. So as part of the tactical asset allocation, instead of just falling into the recession or into the effects of the pandemic, when the fund manager is actually forecasting there, they can now do what we call a tactical asset allocation, where they can temporarily, in the short run, change the asset allocation of the portfolio as well. So they are now going to be shifting from what they want to be able to achieve when you look at the strategic asset allocation, by moving away temporarily from the strategic asset allocation, going back to the tactical asset allocation, where they're now going to be saying, let's rather, if we are going to be approaching, for example, a recession, or we are going to be seeing that our equity portfolio is going to be negatively affected by the pandemic, mainly because of the composition of our portfolio, that's when they can now shift some of their portfolios, where they can now quickly sell some of the assets which make up their portfolio and invest that money in lower risk type of investments. Then over time, as they see now opportunities for them to be able to invest, they can now go back to the strategic asset allocation as well. So looking at this, on the next paragraph, line number 2, they say, poorly managed executions result in transaction costs that reduce performance. So transaction costs include all costs of trading, including explicit transaction costs, implicit transaction costs, and missed trade opportunity costs as well. So explicit transaction costs include commissions paid to brokers, fees paid to exchanges, and taxes. And implicit transaction costs include bid-ask spreads, the market price impacts on large trades, and missed trade opportunities costs arising from price changes that prevent trades from being filled, and delay costs arising from the inability to complete desired trades immediately due to the order size or the market liquidity. Because in most cases, when it comes to the delay cost, is mostly experienced when the economy goes through a recession. Like, for example, when you look at the 2008 recession, where many fund managers, by the time they realize that the economy is going down, into a recession, what were they trying to do? Everyone was trying to sell their assets or their securities, which are risky. And what is happening? There was no one else who's prepared to buy those securities as well. So which means that you're now having a delay cost where you are losing the value of the portfolio, mainly because you're not able to actually execute those transactions on time because of market illiquidity as well. Are there any questions before we go on to section 5.3, which is the feedback step? Any questions? All right. So looking at the feedback step, they say, in any business endeavor, feedback and control is essential elements in reaching a goal. So in portfolio management, the step has two components: monitoring and rebalancing, and performance evaluation. So when you look at the first step, which is monitoring and rebalancing on section 5.3.1, they say monitoring and rebalancing involve the use of feedback to manage ongoing exposures to available investment opportunities so that the client's current objectives and constraints continue to be satisfied. So two types of factors are monitored: investor-related factors such as investor circumstances, and economic and market input factors as well. So those are the factors that are going to be monitored to see exactly how the portfolio has been performing over time as well. So they're going to be looking at these factors to see. So these are the background or the factors that are going to be now used as a background to actually monitor and see if they are going to be able. There's the need for them to be able to rebalance that particular portfolio as well. Then the second component is performance evaluation. And when you look at performance evaluation on section 5.3.2, they say performance evaluation is investment performance must periodically be evaluated by the investor to assess progress toward the achievement of investment objectives, as well as to assess portfolio management skills. So the assessment of portfolio management skill has three components: performance measurement, which involves this calculation of the portfolio rate of return; performance attribution, which examines why the portfolio performed as it did and involves determining the sources of portfolio performance, mainly because you are now going to be dissecting what makes up your portfolio to say, so overall portfolio, our portfolio is made up of asset A, B, C, and D. So now, even though we are saying that the portfolio did perform very well, but what really was driving this performance? Is it because asset A was the only one which was performing, or was it because asset A and B are the only ones which were performing? So that you see that you're now going to be able to isolate the performing assets and and put them on their own, and also isolate the underperforming assets and put them on their own, and also make the decision to say, should we rebalance the portfolio or not rebalance the portfolio as well. Then they also look at performance appraisal, which is the evaluation of whether the manager is doing a good job based on how the portfolio did relative to the benchmark as well. So you're now going to be checking to see exactly when you look at performance appraisal, this way you're now going to be saying, what is the return of the portfolio compared to the benchmark? Are we having a positive alpha, or are we having what? A negative alpha. If you're having a positive alpha, ideally would say what? The manager is doing a good job. But if you're having a negative alpha, it basically means that what? The manager is not what? Doing a not so good job as well. So are there any questions when it comes to section 5.5.3? All right, can we continue? Next, we are now going to look at section 6 of the chapter. So we are now going to look at section 6 of the chapter. And for section 6 of the chapter, looks at investment objectives and constraints. So we're now going to be looking at the investment objectives and constraints, which are going to be covered in the what? Investment policy statement there as well. So looking at those, under objectives, on section 6.1, they say the two objectives of this framework, risk and return, are interdependent. One cannot be discussed without reference to the other as well. Because remember what we said, generally for investors, the higher the risk, the higher the what? The expected return as well. So the higher the risk, the higher the expected return if you're looking at what? Rational investors. So because of this, on section 6.1.1, we addressed the first objective, which is the risk objective. And here they say, the first element of the risk return framework is the risk objective, because it will largely determine the return objective as well. So if you check on the last sentence of that paragraph, we say, in formulating a risk objective, the investor must address the following 6 questions. And the first one is, how do I measure risk? So you need to find out exactly. So for this particular portfolio that I'm considering investing, or this particular asset that I'm considering investing as well, how am I going to measure the risk of the assets or the portfolio that I'm going to be considering what? Investing in? Am I going to look at the standard deviation? Am I going to be looking at the tracking risk? Am I going to be looking at the value at risk as a measure of what? Of risk of the portfolio there. So if you check under that section, on line number 3, they say, examples of absolute risk objectives are specified, are a specified level of standard deviation or a variance of total return. So in this case, if you go to the next, if you skip the next 2 sentences there, the next 3 sentences, they talk about standard deviation, where they say is the positive square root of the variance. They say an example of a relative risk objective is a specified level of what? Tracking risk. So when you look at the tracking risk, they say the tracking risk is the standard deviation of the differences between the portfolios and the benchmark total return. So which means that when you're now going to be saying, so when you look at the tracking risk, you're going to be calculating the standard deviation of the excess return. That's basically what you're going to be calculating there. So you're going to be finding out exactly what is the excess return of the portfolio, or of the assets that are making up the portfolio, or whether it's over time or whatever period of time that you're going to be taking into account there. Then the standard deviation of the excess risk that you would have calculated there is basically what we refer to as the tracking risk as well. We're going to look at it later on in the chapters. I think we're going to be looking at it. It's either in chapter 8 or chapter 12 of the textbook. So we're going to be looking at to see exactly how do you calculate the tracking risk as well. We are going to be covering it. Then the other measure that they talk about there is the value at risk, where they say the downside risk concept, such as the value at risk, may also be important to an investor. So value at risk is a probability-based measure of the loss that one anticipates will be exceeded only if a specified small fraction of the time over a given horizon. So which means in this case, we are basically saying that over a period of time, the loss that you're expecting, or the maximum loss that you're expecting to experience over a given period of time, given a certain probability of occurring, is basically what you refer to as the value at risk. So which means that in this case, you are now going to be taking into account to see exactly what is the level of significance that you're going to be using. And in most cases, in statistical measures, they talk about the value at risk being based on the 90% level of significance, 95% level of significance, or even 99% level of significance as well. So you just need to know what the value at risk concept is. but I don't remember in the textbook where they will ask you to calculate the value at risk, because there is a way of calculating it, but I don't think that for Inv4801 you will be expected to do the calculation of the value at risk as well. Then the second question you have to answer when it comes to risk objective is, what is the investor's willingness to take risk? So the investor's stated willingness to take risk is often very difficult for institutional versus what? Individual investors. So it's very different for institutional versus what? Individual investors, mainly because for institutional investors, the assumption is that they are professionals who are involved. So the willingness to take risk is expected to be higher, depending on exactly what the board of directors would have determined exactly what the risk appetite of the company should be. Then for individual investors, it's now going to be a bit difficult. And remember, it's going to be varying from one individual. It largely varies between one individual to another as well. That's why you see that there are different methods that they usually use to try to gather information exactly what the willingness of the investor to take risk would be as well. Then the third question to address is, what is the investor's ability to take risk? So even if an investor is eager to bear risk, practical or financial limitations often limit the amount of risk that can be prudently assumed. So the following items have to bear in mind, where they say, in terms of spending needs, how much volatility would inconvenience an investor who depends on the investment? So this will also determine exactly what the ability of the investor to take risk would be. And the next issue is, in terms of long-term wealth targets or obligations, how much volatility might prevent the investor from reaching these goals? And another issue to address would be, what are the investor's liabilities or pseudo liabilities as well? Then the next one is, what are the investor's financial strengths? So these are the issues now that you are going to be looking at to determine exactly what the investor's ability to take risk is. Then on point number 4, this is where you look at how much risk is the investor both willing and able to bear. So now this is where you are trying to now get to an overall assessment to say, if the investor is saying that they are so eager to take risk, but at the end of the day, this is how much they are able to take risk. This is where you now have to now sit down with the investor and also explain to them, so that you can now come up with a middle ground now to say, if your willingness to take risk is this, but your ability to take risk is this much as well, then overall, how much risk are we going to be able to actually say or allocate to this particular investor as well? So you always have to make sure that when it comes to the risk objective there, you always have to check to see on the case study that would be given, what is the investor's willingness to take risk, and what is the investor's ability to take risk as well. And remember what we said, the willingness to take risk usually is going to be given in as a note to say, because of previous experiences, so sometimes they even say, because of experiences to take risk, the investor is very much wary of actually taking on risk, or they are afraid of losing value when the market fluctuates quite a lot as well. So because of that, you're now going to be able to see exactly, ideally, what the willingness to take risk of the client would be. And remember, when you look at the ability of the client to take risk, from the case study that you'll be given there, you now need to check to see exactly what are the liabilities that the client is facing, and what are the assets of the client as well, and what is the relationship between the assets and liabilities of the client, and also based on exactly how much they are going to be needing to withdraw as well, you can also be able to use that now to have an idea of exactly what the ability of the client to take risk would be. Because if the client wants to be constantly taking out money, it means that the ability to take risk also becomes lower as well. So you always have to make sure that you are able to actually address and assess these issues when you're now looking at your case study, for you to be able to now take into account what the ability of the client is to take risk. Then once you're able to address these two issues under risk there, that's when you're now going to now look at it overall to say, based on the willingness and ability to take risk, this is what we're now going to be allocating as the ideal risk for a particular client as well. But we're going to be looking at it in detail in the next chapter when we look at what investment policy statement for individuals as well. So on section 4, on line number 8, they say, when a mismatch exists between the two, which is the willingness to take risk and ability to take risk, determining the risk tolerance requires educating the client on the dangers of excess risk-taking or of ignoring inflation risk, depending on the case. So which means that you now have to make sure that you sit down with the client and also advise them so that they're also aware of exactly what are the dangers involved when it comes to what taking the risk. Because in most cases, you find that you would find a situation where the client is saying they want to make as much money as possible, but they are not that willing they're not that willing to take risk as well. That's why you see that there has to be a link between the risk and return, because remember, the higher the risk, the higher the expected return. But if they're not prepared to take on risk, they should also expect what? A lower expected return at the end of the day as well. So you should always make sure that these two are always going to be what? Linking with each other as well. And they need to understand the relationship between these levels of risk and also the ability and willingness to take risk as well. So Exhibit 1.2 can be used as a guideline on the assessing the overall risk tolerance of the client as well. So you see that here they're basically saying that if the willingness to take risk is below average and the ability to take risk is below average, overall, you're going to be putting this client into a below average risk. You're now going to be allocating a below average risk tolerance for this client as well. But if the willingness to take risk is average, is below average, and the ability to take risk is above average there, it basically means that you need to come up with a resolution, which means that you need to sit down with the client and they come up with the resolution as well, which basically means that when it comes to answering such a question in the exam, it would mean that it's going to be a bit more subjective exactly what your overall what the overall allocation is. But we'll see, I'll tell you exactly some of the techniques that you can also use to answer such questions in chapter 2 when we look at chapter 2 as well. Then if the willingness to take risk is above average, but the ability to take risk is below average, there is a need for the resolution, because you still need to educate the client so that they're able to actually mitigate and come up with a resolution exactly what the overall risk rating should be. But we're going to look at it in detail when we look at chapter 2. And then when the willingness to take risk is above average and the ability to take risk is above average as well, it basically means that this is where you can look at what above average risk tolerance that you can allocate to the client as well. So this is how you can actually use as a guideline or general guideline for you to be able to now recommend exactly what the risk tolerance should be for the given client that would be assessed as well. The first question to be asked when it comes to risk is, what are the specific risk objectives? So which means you now need to find out exactly what are the specific risk objectives. So here they say, just as risk may be measured either absolutely or relatively, we may specify both absolute risk and relative risk objectives. In practice, investors often find that quantitative risk objectives are easier to specify in relative than in absolute terms. So possibly, as a consequence, absolute risk objectives in particular are frequently specified in quantitative rather than qualitative rather than quantitative terms as well. So this is basically where I can say, if it's in qualitative term, this is basically where you're going to be saying, is it below average, is it above average, is it average, depending on exactly what your assessment should be as well. Then the sixth question that you're going to be asking is, how should the investor allocate risk? So here they say, this is how some investors frame capital allocation decisions today, particularly when active strategies will play a role in the portfolio. So the question may concern the portfolio, as a whole or some part of it. So risk budgeting disciplines address the above question most directly. So after the investor has determined the measure of risk concerned to him, and the desired total quantity of risk, an investor using risk budgeting would allocate the overall risk budget to specific investments so as to maximize expected overall risk-adjusted return. So the resulting optimal risk budget for the investments would translate to specific allocations of capital to them as well, because at the end of the day, when you're now looking at allocating the risk budget there, this basically we are now going to be saying that which asset allocations are we going to be looking at, given that at the end of the day, you want to be able to maximize your return for a given level of risk, and you also want to be able to minimize your risk for a given level of for a given level of return there. So you are going to be bound by those objectives now when it comes to allocating your risk, depending on exactly which assets you are going to be looking or considering investing in as well. So is there any question when it comes to the risk objectives before we go on to the return objectives? Now, looking at the return objectives on section 6.1.2, on the last sentence, they say, in formulating a return objective, the investor must address the following 4 questions. 1, how is return measured? So are you going to be using an absolute amount, or are you going to be using a nominal return base, or are you going to be using a real return base as well? So here they say the usual measure of total return, the sum of the return from price appreciation and the return from the investment income. So return may be stated as an absolute amount such as 10% a year, or as a return rate with the benchmark's return such as a benchmark return plus 2%. So nominal returns must be distinguished for real returns. So for the real returns, from real returns, where nominal returns are adjusted for unadjusted for inflation, and the real returns are adjusted for inflation, and sometimes simply called inflation adjusted returns. So also pre-tax returns must be distinguished from post-tax returns as well. So which means if you're not looking at these returns as well, you should also make sure that you take note to say when you look at the returns, your nominal return, but we're going to be looking at it in detail when we look at chapter 2 as well, where your nominal return can be given as 1 plus the real rate of return multiplied by 1 plus expected inflation minus 1. So this is how you can calculate the nominal rate of return. Or sometimes it can also simply, you can also use the additions method, where your nominal return can also be given as your real return plus your expected inflation. So this would give you your nominal return, depending on exactly what the question is asking you to use as a method of calculating your nominal return as well. Then your returns can also be pre-tax or after-tax, where we know that your after-tax rate of return, your after-tax return would be given as your before-tax return multiplied by 1 minus tax rate. So your after-tax return can be given as your before-tax return multiplied by 1 minus tax rate. But we're going to be looking at this in detail later on when you look at it in chapter 2 as well. So make sure that you bear in mind how you are going to be able to calculate the different or to measure these given returns as well. If you are going to be using the nominal, or you are going to be looking at pre-tax or post-tax returns. And remember, in the question, usually it guides you to say which type of return are you going to be using, especially when it comes to the use of after-tax returns or before-tax returns. And remember, if ever you are asked to determine the before-tax return, you should also know that before-tax return is given as your after-tax return divided by 1 minus tax rate. So your after-tax return divided by 1 minus tax rate will give you the return before tax. And sometimes when you're preparing the investment policy statement, it will guide you to say you should be calculate this return, your return objective is, should it be before tax or should it be after tax as well? You need to be able to know how to play around with this as well. But we'll look at it later on in the next chapter when you look at the different returns. Are there any questions before we go on to the second question to be addressed? The second question to be addressed is how much return does the investor say she wants? So you need to check to see exactly what the desired rate of return would be for the investor as well, so that you're able to now know exactly what the investor is trying to achieve and how ideally how much they want to be able to get as well. Then the third question is how much does the investor need to achieve on average? So this amount is the required return or return requirement. So this will give you exactly what the investor needs to return generate on average, which means that the required return or the return requirement is now going to be based on exactly the need to access funds as a percentage of the value of the fund of the investable assets as well. So the need to access funds as a percentage of the investable asset would tell you exactly what the return or requirement would be. But we'll look at it when we look at different investments as well. Now, when it comes to generating the returns as well, you can also calculate the returns based on what we refer to as the modified internal rate of return. So which means that when you're trying to find out exactly what the return of the portfolio would be over a given period of time, you can calculate what we refer to as the modified rate of return. And the modified rate of return, so you can calculate what we refer to as the modified rate of return. You can also calculate the before tax return, which is what we've discussed so far. And you can also calculate the nominal rate of return, which is also given by that as well. So I'll explain this in detail. So you see that when it comes to the modified rate of return, we're basically saying that the modified internal rate of return is given as your end value over beginning value to the power of 1 over n, which is the investment horizon. So 1 over n, which is the investment horizon, minus 1. Then if you multiply that by 100, this is how you're going to be able to determine what the modified internal rate of return is if they are asking you to calculate the modified rate of return as well. And remember what I discussed with you previously, the before tax rate of return can also be given as your after tax rate of return divided by what? 1 minus tax return. This is how you can also calculate it as well. Then your nominal return can also be given as your real rate of return plus inflation premium plus risk premium as well. So which means this is basically where you are basically saying that your nominal rate of return can be given as your real rate of return plus expected inflation plus what? The risk premium as well, if they mention any risk premium. So this is how you're going to be able to determine exactly what the nominal rate of return would be as well, depending on it. So it's very subjective depending on exactly what information they give you on the question that is relevant for the case study as well. Are there any questions before we go on to the fourth question to be addressed when it comes to the return objectives? So on the fourth question, they say, what are the specific return objectives? So the return objectives incorporates the required return, the stated return desire, and the risk objective into a measurable annual total return specification. So which means that the specific return objective now is now going to be now taking into account what the required return would be based on exactly how much you're saying that ideally to achieve this overall aim, how the overall goal of the client, how much the portfolio should be generating as a return, what the stated desired rate of return would be for the client, so that you're able to actually find out exactly what the overall return should be for that particular portfolio to be able to achieve its objective as well overall in the long run. Next, on section 6.2, we now look at the different constraints. And the first constraint that we're going to be looking at there is the liquidity constraint. And here they say the investor, before we go there, they say the investor's risk and return objectives are set within the context of several constraints: liquidity, time horizon, tax constraints, legal and regulatory factors, and unique circumstances as well. So in section 6.2.1, which looks at liquidity, they say a liquidity requirement is a need for cash in excess of new contributions or savings, right? So at a specified point in time. So such needs may be anticipated or unanticipated, but either way, they stem from the what? Liquidity events. So which means that this is basically the need for cash in excess of what? New contributions, right? So which means that in this case, we are basically saying that over the investment horizon, the need for cash in excess of the contributions that are going to be made or savings that are going to be made as well is basically what we are going to be deeming as the liquidity need there as well. So which means that in this case, it would mean that you now need to check on the case that is given to say, is there any need for cash over the investment horizon that the client has stated? And some of the examples of that would give rise to the liquidity needs is where maybe they can say after 6 months, the investor wants to take out some money to pay for something, or they say after 2 years or after whatever period of time, the investor wants to take out a certain amount of time, amount of money, so that they pay for their child's what? Education need. So that becomes a liquidity need because it's going to end up affecting how much is being invested in the portfolio. Because what? After that given period of time, there has to be what? Money that has to be withdrawn to meet that specified need as well. And remember, they can be anticipated or unanticipated as well. Like for example, if there's going to be a funeral and the client is sitting with an investment account and they don't really have other options there, the only other option that they'll be having is what? Is to be able to what? Access that investment, that part of that investment as well. So these are some of the unanticipated needs that can also arise, which affects what? The liquidity needs on the portfolio as well. So on page 16, second paragraph, line number 4, they say, any risk of economic loss because of the need to sell relatively less liquid assets to meet liquidity needs is liquidity risk. So which means that the liquidity risk in this case is gonna be because the client is saying that I want to be able to access the money because of some emergency need. There is now the risk that they might end up what? Selling this investment because the asset is not easily sold on the market, or the type of investment there's not that much demand for that particular investment to be bought. And because of this, when they now end up selling the investment, they'll end up what? Struggling to sell this asset at the fair price, mainly because what? There is less demand for that asset when they were trying to sell the asset there. So this is basically where the liquidity risk basically comes in as well. And then there's also price risk. I just need to highlight this as well, where with price risk, they say as distinct consideration in liquidity requirements is in relation to price risk of the asset, which is the risk of fluctuations in what? In market prices as well, which basically means that now, because the market prices sometimes, or some of the assets or securities, they fluctuate quite a lot as well. Now you are having a situation where there's price risk, where you are now going to be selling the security at a price where the price is now, the market is experienced what? A downward swing. And when the market experiences that downward swing and the client says that they want to access their money, they're now going to be forced to actually what? To sell the security at a lower price, because what? The client is saying that they want to what? Access the money there. So which means that they now end up what? Having price risk as well. So is there any questions regarding liquidity needs before we look at time horizon? Any questions? On section 6.2.2, they look at another constraint, which is time horizon. And yet they say time horizon most often refers to the time period associated with the investment objective. Then if you skip the next paragraph, they say, in general, relevant time horizon questions include the following. First one, how does the length of time horizon modify the investor's ability to take risk? So the longer the time horizon, the more risk the investor can take. Mainly because, for example, which means that you now need to check to see exactly your investment portfolio, or the fix, especially when it comes to the pension funds as well. When you're looking at institutional investors, you're now going to be saying that if the portfolio is made up of, or the company has a lot of young employees, it basically means that if they are going to be investing money in the pension fund, they can now be able to actually take on more risk. Why? Because they have they have a young workforce. If they have a young workforce, it means that they have a longer period of time before they need to access the money in the pension fund, and because of that, it also increases the ability to take risk. But if they have an older workforce, or if it's an older person, it reduces the ability to take risk as well. The second one is, how does the length of time modify the investor's asset allocation? Like what we saw here, it means that when you're now looking, remember we said you can either invest in money market, bonds, real estate, and equity there. And remember we said the more you're moving between money markets, going all the way to the equity there, risk is increasing, expected return is increasing, but the time horizon is also is increasing as well. So which means that the longer the time horizon, the more they're able to actually invest in the riskier assets as well. The next one is, how does the investor's willingness and ability to bear fluctuations in portfolio value modify the asset allocation? So here they say, with focus on risk, even an investor with a long-term objective may limit risk-taking because of sensitivity to the possibility of substantial interim losses as well. So which means that you also have to bear in, so it does not always necessarily mean that a long time horizon always translate into a higher willingness and ability to take risk as well. Because if the client is not that willing to take risk, it basically means that you now have to play around to see exactly what allocation you're going to be giving them. Because remember, the allocation is also going to be affecting the risk that the client is also going to be getting as well. Then the next one is, how does a multi-stage time horizon constrain the investor's asset allocation? Because remember, if it's a multi-stage time horizon, this is basically where you're basically saying that the investor is, maybe, let's say for example, the investor is 50, let's say the investor is 52 years of age and is planning to retire at 55 years of age. And then they are also looking at their portfolio post-retirement as well. So this way, it basically means that you are having a multi-stage time horizon, because the investor has now, the first time period is going to be between now until the investor reaches retirement. Then the next time horizon, or the next stage of the time horizon, is now going to be between retirement age until the anticipated time at which the client should die as well. So because of this, you now need to check to see exactly your time horizon. Is it a single stage time horizon, or is it a multi-stage time horizon? And also this has an effect on exactly how much risk you're going to be allocating for the different parts of the portfolio as well. The next issue that you're going to be looking at, or constraint that you're going to be looking at there, is tax concerns. And when it comes to the tax concerns, they say a country's tax policy can affect important aspects of investment decision making for investors who reside there. So which means in this case, you need to take into account and see exactly what are the tax issues and where ideally the investor would be investing in as well. So you are not expected to know the intricate workings of the different investments, like for example, how the unit trust works or how the endowment policies would work, if you look at it from a South African perspective as well. But the idea is, when it comes to the tax issues, you now need to check to see, normally the issue that you need to be able to address there is to see exactly what are the tax implications when it comes to income tax, and what are the tax implications when it comes to capital gains tax as well. Because if the income tax is higher than capital gains tax, normally it would mean that the investor is better off reinvesting their the returns in their portfolio than getting income, because if they're going to be getting the income from the portfolio there, they're going to be charged at a higher tax rate than if they reinvest these investments, and then at the end of the investment horizon, they're just going to be charged the capital gains tax, which is lower than the income tax as well. So those are some of the tax issues that usually come across when it comes to investment policy statement structure as well. So you need to make sure that you're able to take them into account. The next constraint is legal and regulatory factors. And here they say Legal and regulatory factors are external factors imposed by governmental, regulatory, and oversight authorities to constrain investment decision making. So which means in this case, you have to take into account exactly what are the legal implications when it comes to regulatory issues, when it comes to what movements of your money in your portfolio or investing the money in the portfolio as well. And one of the common issues that they usually, the lecturer loves to bring about when it comes to legal and regulatory issues there is where you always have to bear in mind, for example, they will tell you that the client is over invested in her own employer's what? Security there, or companies shares, right? So which means that over time the client might need to diversify their portfolio instead of over investing those shares of the company as well. So what is going to happen? It means that you are now going to be trying to advise the client to diversify their portfolio over time, so that at the end of the day they are not overexposed to the company's shares. Sometimes they also put in to say the shares are highly volatile as well. So because of this, it would mean now when it comes to the legal regulatory issues now is where you have to bear in mind the issue of insider trading, which means that they need to make sure that they do the proper disclosures when the client is now considering moving the securities of their employer to other forms of investments as well. So those are some of the legal and regulatory issues that you have to bear in mind or indicate or highlight when it comes to your investment policy statement that you're going to be preparing as well. The last one, or the last constraint that we're going to be looking at, is unique circumstances. And here they say unique circumstances are internal factors other than liquidity requirement, time horizon, and tax concerns that may constrain portfolio choices. So these ones, they are quite open-ended. So because of this, I'm just going to highlight some of the examples of unique circumstances here. So they say, for example, an university endowment may be constrained to avoid certain investments against which there may be ethical objections or social responsibility considerations. So similarly, an individual investor portfolio choices may be constrained by circumstances focusing on health, needs, support of dependents, and other circumstances unique to the particular individual. So investors may specify avoidance of non-domestic shares or derivatives. So portfolio choices may also be constrained by investor capability in terms of both human resources and financial resources, such as time, interest, background, or technical expertise. So those are some of the open-ended issues that can also form part of unique circumstances, which means that the whole idea of you being able to identify that it's a unique circumstance there is that it's something that is unique to that particular investor. So it can be coming on or coming from any one of these issues that they've given in as an example there. So you need to just make sure that you're able to take into account these, so that if they give you a unique circumstance there, you'll be able to actually allocate it under unique circumstances. Because remember, it will be one of the constraints which are basically not any one of those constraints that have been set above as well. So these are the objectives and constraints that you have to take into account when it comes to the preparation of the investment policy statement. Is there any questions? Any questions when it comes to the constraints and objectives? Because you are going to be using this as your foundational knowledge when it comes to now preparation of the investment policy statement for individuals or institutional investors as well. Any questions? So on your own, you can just go through section 7, section 8, and section 9. There's nothing much that I would say would be highly examinable. You just need, for practical purposes, in practice, yes, you need to take note of these issues, like when it comes to the dynamics of the process, the future of the portfolio management, and also the ethical responsibility of portfolio managers as well. But which I'm going to highlight a little bit after this. But there's not much that you're going to be expected to be examinable. The most important thing there when it comes to this section is being able to know how you draw up your investment policy statement, where you're looking at being able to identify the objectives and the constraints as well. So on section 9, which looks at the ethical responsibility of portfolio managers, on page 19, line number 6 from bottom, they say the portfolio manager must keep foremost in mind that he or she is in a position of trust, requiring ethical conduct towards the public, client, prospects, employers, employees, and fellow workers as well. That's why you see that, for example, if you are studying for the CFA designation, you are always going to be asked a section, whether you're doing level 1, level 2, or level 3, you're always going to be asked, you're always going to be having a section which covers ethics as well. So there's always going to be a need for you to be able to act ethically, especially when it comes to the portfolio managers, because they are the ones who are going to be managing the funds on behalf of the clients. So after this is where we are going to end when it comes to chapter 1. So the next chapter that we're going to be looking at is chapter 2, which looks at individual portfolio management, where we look at preparation of the investment policy statement for individuals. And remember, chapter 3 also looks at the investment policy statement for institutional investors as well. Are there any questions? Any questions? So if there are no questions, this is where we're going to end today. So I'm going to make sure that within a week, by the time we get to Easter, I would have uploaded the video of the session that we would have had today, so that we have enough time to go through these sessions before we go on to the next class as well, before you attend the next class. And what I'm also going to make sure that I do is that before the next class, I'm also going to upload the existing video of the second chapter that we did in the previous year as well, so that you can use that video as a guide to go through chapter 2 in advance if you'd like to work in advance as well. So please make sure that you use your practice as much as possible. And what I'm going to do as well is that when we do chapter 2, I'm also going to give you a homework, because chapter 2 is one of the chapters which are highly examinable. So you need to make sure that you are practice and understand exactly how to approach these questions in the exam as well. So after we go through chapter 2, I'm going to give you a homework question where you need to go through one of the past assignments or past exam papers as well, so that you're able to understand exactly how to approach the preparation of the investment policy statement for individual investors as well. All right, if there are no questions, we end here today. Enjoy the rest of your weekend and Easter as well.